Hello, welcome class. Welcome to Business Law class. We are using 2022 McGraw-Hill Canadian Business Law today. Okay. Let's start this chapter. This is owned by McGraw-Hill. Okay, in terms of copyright, the slide is owned and prepared by John Piccolo from Niagara College. Okay, let's start this class. There's a number of 6 learning objectives. The first one is understand the different financial institutions which business have access to. Number 2, understand the electronic commercial transactions. Number 3, explain the financing business operations. Number 4, understand the remedies available to secure and unsecured creditors. Number 5, to describe insolvency and bankruptcy and procedures involved. Number 6, rank the creditors and in bankruptcy. Let me just lower my chairs. It's more convenience to do all the lectures. Okay. So we can start again. The next slide. Well, it's all settled down. All right, let me start again. So next slide. What is financial institution? Financial institution can be federally and provincially chartered. Okay. What are they? Let me just discuss in detail here. Federally chartered banks, foreign subsidiary banks, and branches of foreign banks are regulated under Canada Federal Bank Act, and provincial chartered Canada trust and loan companies, credit unions, and some insurance companies. Okay. Financial institution, there will be an agreement between a business and financial institutions. This agreement covers all service offered by organizations, include matters such as who will be liable if a mistake is made or how long the checks and funds will be held before they are made available. Electronic transfer funds where e-banking is available has greatly reduced the use of the checks. What is the checks? The bill of exchange drawn against bank and payable on the demand. So this is mostly the common thing to do, using checks. But most of the time now, electronic transfer is done by e-transfer or wire transfers. Okay? Credit card, debit card. The use of credit card, debit card as a financial transaction has grown enormously in Canada. Merchant pay a fee to card issuer, Visa, American Express in order to participate in a credit card or debit card network. Credit card, debit card, code of conduct, credit card, debit card introduced in Canada. The code, the purpose of the promotion of fair business practice and increased disclosure with the goal of helping both consumer and merchant understand the costs and benefits associated with the use of credit and debit cards. There's two types of financings here. For the first one is the debt financing, capital, borrow capital for a period of time and repaying the loan, plus any interest charged in accordance with the terms of the loan agreements. Number 2, which is equity financing, selling shares in corporation to shareholders. So this is what we have done in the past when I was in capital market, doing equity financing as well as debt financing for a company that wants to go public and raise fund in the capital market. Okay, these are the two most common example that a company can do. Secured creditors, financial institutions want to have a loan secured against some valuable property or assets of the borrower. The primary interest is the debtor ability to repay, and the debtor can provide reassurance to the creditor that they can claim and sell some valuable assets such as collateral or the debtor if they cannot repay. A secured interest is the collateral is created through an agreement between the lender or the borrower referred to as the security agreement. Security interest is an interest in a personal property that secure the payment of a debt. Security agreement is an agreement that settles the rights and obligations of the borrowers and the lenders and create a security interest in the personal property of the borrower. Okay? Floating charge is a security interest on a class of collateral which may change that allows debtor to dispose or replace and added to the assets of that class, such as inventory of a business. In the event of a default under the loan, the lender can sell the secured asset. If the sale proceeds are not enough to eliminate the debt, the creditor can start a legal actions. Creditor must make a reasonable effort to obtain a fair price for the asset being sold. If the sale or result in funds that exceed the debt, the excess amount is paid to the debtor. Security of a loan can be taken against any real property in the form of a mortgage. Okay, this is what I done. When I buy a house, I have to use a mortgage because I don't have enough money to pay all lump sums, right? I pay, and then I pay for I take 30 years loan. So every month I have to do a payment to the bank. To the bank. Security of a debt can also be taken against personal property such as account receivable, equipment, inventory, corporate shares, and intellectual property rights. Okay. The secured credit can register its interest in the personal property to a public registry system such as a PPSA, which is govern the creation, protection, to registration, enforcement of security transactions involving personal property. PPSA. So there's a public registry system. Let's say you owe somebody, you don't pay, they're gonna register your debt to them. So it's gonna affect your credit score. Guarantor or cosigner is individual who agree to pay the debt with another person if that person default in making payment to the lender. The guarantee must be in writing and signed by the guarantor. Until default occurs, there is no liability on the guarantor. Equity financing, alternative to debt funding, is equity financing, which involves selling shares to investors who receive an ownership interest in the corporation. Investors participate in the potential growth or failure of the business operations. What is crowdfunding? This is the new trend now in the millennial era. Crowdfunding is a way to fund a project or venture by raising many small amount of money from a large number of people using internet. Okay, so you do a social crowdfunding where you use like Facebook, Instagram, TikTok, and all those things. Money raised could be seen as a loan, as a capital in the form of equity, a gift, or business income. Private or public companies are able to raise funds by crowdfunding to a maximum amount of 1.5 million or any 12-month period. Bankruptcy, in terms of insolvency and bankruptcy, there is a law to it. Bankruptcy and Insolvency Act, Company Creditor Arrangement Act, the law relating to insolvency or bankruptcy in Canada, are aimed at preserving the assets of debtor for the benefit of the creditors. It also provides the debtor with opportunity to restructure and let go of the burden of the debt and start again. The Federal Bankruptcy and Insolvency Act governs all insolvency and bankruptcy in Canada. It details the responsibilities and rights of all parties involved in the process. The Superintendent of Bankruptcy, an official receiver, a court, licensed bankruptcy trustee, and debtor and creditor. So there's a trustee who will oversee all the Bankruptcy and Insolvency Act. So if you're bankrupt, then the trustee will go over the assets and sell the assets for the creditor. A business insolvent, if it's insolvent, if it's owed creditor more than 1,000 or more and is unable to meet its obligation, generally as they come due. The Act allows debtor to make proposal to their creditor to restructure the debt and try to reach a compromise. If the proposal is accepted, then the debtor does not go into bankruptcy as long as they live in the terms of the proposal. That's the key part. You have to pay your debt. If proposal is rejected, then the debtor can make an assignment into bankruptcy voluntary, or the creditor may apply to the court have a debtor petition into bankruptcy. Most common act of bankruptcy is debtor inability to meet its obligations generally as they become due. Assignment into bankruptcy. If the debtor decides to act voluntarily, the assignment into bankruptcy is filled with an official receiver for that area. Authorities in bankruptcy take control of the debtor assets, confirm creditor claims on the estate, sell the assets, and distribute the proceeds according to each creditor percentage of interest in the state of bankruptcy. Debtor petition into bankruptcy means the court will have transferred substantially all of the debtor assets into the hands of a court appointee trustee in the bankruptcy. The debtor will be allowed to retain some basic assets such as clothing, tools, trade, and furniture. Okay, you don't want to have bankruptcy. There's a lot of mess there. But if you can try to avoid it as much as possible. If not, then you have to go to the step. Creditors in terms of bankruptcy. Secure creditors. This class of creditor may take possession of secure goods and sell them to pay the debt. The preferred creditors. This class of creditors include the trustee in bankruptcy for the fees involved in the bankruptcy processes, funeral expenses, and landlords up to 6 months back rent or lease on these premises. Employee for claims unpaid wages. This is the preferred one. Okay. For the unsecured creditors, this class of creditors shares in the total remaining proceeds from the sale of the debtors estate after the payment of the preferred creditors. Its unsecured creditors receive a percentage of what was owed to it. In terms of court, they usually discharge the debtor from bankruptcy without condition within 1 year. However, if creditor object to the unconscious discharge, the debtor may receive conditional discharge. An absolute discharge remains subject to a certain debt that a bankruptcy cannot extinguish, such as order of family support or a court-based assessed penalty. This is how it goes. Before bankruptcy, review the option, gather information, sign and file documents. During the bankruptcy, make payment until submit budget, credit counseling, no credit, no collection call, less stress. This is bankruptcy. And then do a fresh start. After bankruptcy, no more debt, start saving, restore credit, set financial goal. So guys, if you have a bankruptcy, it takes a bad process. A lot of people, you cannot buy a car on lease or finance. You cannot get mortgage. And some tenants, if you have renting, if they check your credit score, you have been bankrupt before, they don't, they would not like to have you as a tenant there because of the payment issue. The same thing in the insurance company. If you want to pay and lump, partially, they also check your credit score as well as your bankruptcy history. Again, Company Creditors Arrangement Act, the Federal Companies Arrangement Act governs the insolvency of the corporations. Allow the insolvent company with total debt over 5 million to restructure its financial affairs. Allow business to avoid bankruptcy while the creditor receives some form of their debt payment. These are the key questions, okay? How are the credit cards governed? How are the advantages of debt versus equity financing? If you pay debt, then you remember you always have to pay that debt. What is the next security agreement? The third one. And explain a reason a third party may be asked to co-sign a loan by someone borrowing money from the bank. Let's say if I am going to the US, I don't have a credit history in the US, so I can ask my brother to co-sign it in order for me to get the loan. Number two, identify the risks and benefits of overcrowding. Who are the parties? Guarantee. And what are the rights and obligations of each party? What is the definition of insolvency? Where is it found? What constitutes of bankruptcy? What kind of debt that is extinguished or by unnecessary discharge from bankruptcy? Key terms that you need to know. Checks, it is the bill exchange drawn against bank and payable on demand. Okay, that's the check. That financing is borrowing capital for a period of time and repaying the loan plus any interest. Equity financing is selling the shares in corporation to investors. Security interest is interest in personal property that secures the payment of a debt. Security agreement is an agreement that sets out the rights and obligations of the borrower and lender and creates security interest in the personal property of the borrower. Floating charge is a security interest on a class of collateral which may change that allows the debtor to dispose or replace and add asset in the class. Guarantor is an individual who agrees to pay debt of another person if that person defaults in making a payment to the lender. Crowdfunding is a way to fund a project or venture by raising many small amounts of money from a large number of people using the internet. So what is secured creditor? This class of creditor may take possession of the secured goods and sell them to pay the debt. Preferred creditor, this class of creditor includes the trustee in bankruptcy, funeral expenses, lenders for up to 3 months back rent, and to some employees claim for their unpaid wages. Unsecured creditors means this class of creditors shares in the total remaining proceeds from the sale of the debtor's estate after payment of the preferred creditors. So that basically concludes this chapter. I will upload this in YouTube as well as a puzzle for your interactive learning. Thank you. Bye-bye.